So welcome everybody to our webinar from the Sign Association of Canada. Today's topic is surviving and thriving with leasing in a depressed economy. And our speakers are Mike Wilson and Chris Waite from Catalyst Finance. My name is Hilary Prue, and for the Sign Association of Canada, I am the Events and Meetings Manager. And in Ontario, for the Ontario Sign Association, I am the Member Services Manager. Just wanted to bring your attention to a few SAC pieces of information. So firstly, whatever region you are in, you are part of a fulsome group of all your regional, the national organization, as well as the International Sign Association. The ISA is maintaining a page on business resources, which is particularly helpful right now with a lot of us stuck at home. And so is the Sign Association of Canada maintaining a business resource page devoted to COVID-19 information. There is a lot of training available to you through the International Sign Association. So I recommend you check that out, especially if you have extra time right now. We are on social media. So SAC is on Twitter and Facebook and Instagram and LinkedIn. So you can also find your regional, provincial associations on there as well. And we do send regular newsletters. We've stepped up how often we send those right now. So you can join the ISA's daily industry digest if you'd like. And for SAC, if you are not already receiving those, you can email Tina Kendrick at sacmembership@signs.org. So with the business out of the way, I would like to hand over the presentation to Chris and Mike, who will talk to us about leasing. Welcome.
Okay, thanks, Hilary. I'm glad everybody that got on. I'm just going to share my screen here for everybody. Okay. Okay. So can everybody see that? Mike and Hilary, can you see that?
Yes.
Yeah. Okay, guys. So I want to thank Hilary and the Sign Association of Canada for having us on today. We want to give you a little background on Catalyst, and then we want to share some information with you on the sign industry, the overall economy, and some strategies, you know, how to sell a sign and how to eliminate receivables or reduce receivables in an economy like this. So the topic of the presentation today is surviving and thriving with leasing in a depressed economy. A little bit about Catalyst. We are a Canadian-owned company. We've been around since 2005. We operate in all provinces and territories, and we also operate in the US as well. We've dealt with about 16,000 businesses over the last 10 years in business. We've got a great perspective on what businesses deal with in a good economy and a bad economy. We want to share some of that with you, and we're going to relate it to the ability to sell signs when times are a little more difficult today. So I'll start the presentation. We work with a model that we call the two buyers, and we work this with any of our equipment companies that we work with that sell, whether it's compressors or equipment or software or trailers. We use the same model going forward. So I'm going to touch on it initially so you understand it, and then we'll refer back to it as the presentation goes on. So in any sales cycle, there's generally two decision makers. There's the technical decision maker and there's the financial buyer. In our world, Catalyst helps companies that sell equipment with the financial buyer. That's what we do. We find ways to make it easier for them to buy equipment. So to understand our thinking or our model on this, how we go about it, the technical decision maker in a typical sales cycle when you're trying to sell a sign could be the purchasing manager, it could be the owner, it could be the general manager, or have any various titles. And the technical decision maker really wants to see, okay, from a technical point of view, is this sign going to fit on our building? What wiring do we need? Are there risks? Are we going to want to upgrade the sign down the road? They want to focus on the technical side of the sign or whatever equipment that they're buying. The financial buyer in our world, in some cases, can be the same person. It could be the owner, but a lot of times it's a controller. It's a VP of finance. It's somebody that handles the money. And the financial buyer, when somebody buys a sign, is really controlling the budget. They're going to find the money for the sign. and they focus more on acquisition costs. And so as we go through the presentation today, we're gonna show you some different ways to present acquisition costs of a sign. And we're also gonna not only inform how they buy it, but how they make deposits to you and how you get paid after the sign's installed as well. So a little bit about what we finance. We've been financing signs, I'm gonna say probably back to 2005 when we started, 2006, and we didn't focus on the market, but over time, signs have become an asset that we've done more and more of, and that's why we joined the Ontario Sign Association last year. Typical types of signs that we'll finance right now are pylon signs, outdoor storefront signs, display monitors, electronic scoreboards, slot load signs as well. There's a few types that we don't finance, like wraps and that right now, but for the most part, we can do most of the signs that are out there. We can do them. We've already done them. What a lot of people don't realize is we can also finance the soft costs. So whether it's an installation cost or labor, shipping, engineering design, that can also be bundled into a lease when somebody is acquiring a sign. And the other thing we want to touch on is a lot of the equipment required to make signs, wide format printers, laminators, cutters, CNC machines, and even software is something that we finance all the time. So we've got a really good understanding of the assets, the signs. We understand that with a typical sign, there is an installation cost. A lot of times there's shipping, there's engineering, there's wiring, if the electrical has to come in to set that up. And we know what equipment takes to make signs. So we've got a good understanding of the equipment and what the assets are, which allows us to have a good offering for you and your and the sign company members. I'm going to go back a little bit and touch on where we were as an economy in 2019 and before, and how people were buying then. And then we're going to come forward to kind of the last 3 or 4 months, what's happening and how people are buying now. And in 2019, it's right around 80% of businesses use leasing. And it seems like a high number, but when you look at people buying photocopiers or forklifts or vehicles for their business, those industries or those verticals use leasing effectively, and they really push leasing. And so it's what we call vendor driven. So if somebody's selling a photocopier, if you walk into a car dealership to buy a car or a truck for your business, they're going to have financing or leasing available to you. It's generally very simple and convenient for them, a lot simpler than dealing with a bank, and that's really what drives a lot of the leasing market in Canada. In 2019, and probably for 7 or 8 years before that, companies had access to bank money. The economy was strong. What we call CapEx or capital expenditure was not a scary thing. So if somebody was going to buy a CNC machine or a sign or some type of equipment, they had options. They could write a check for it. They could go to the bank. Banks and cash were really the preferred methods of buying equipment. And leasing was another good option if offered by the vendor. That in certain cases, the time of year, if a business was having a bit of a slowdown, if there's seasonality to the business, leasing was a great option for those people. And it was a simple option to acquire assets. So that's kind of where we were in 2019. And that applies to signs as well. We started to do a lot more signs in 2017, 18, and 19 in our business. If we jump ahead to now, where we are now in the last 3 months, 3.5 months, what's gone on? COVID has really forced the financial buyer to play defense. And we're seeing that every day on the news, and probably some of us are experiencing that in our business life every day. Bank and cash are not a great option right now for acquiring equipment. We're seeing every day people cutting costs, laying people off. Companies have gotten into a mode right now where they're really trying to conserve capital, and they're trying to maintain and manage those credit lines that they do have. And a lot of business owners that we've talked to over the last several months that were in business in 2007, 2008, 2009, they remember what they went through back then. And they remember the impact the banks had on them, whether they had a line of credit that was reduced or taken away or called altogether. And they know that cash is a big thing to have on hand right now, and preserving those credit lines for payroll and daily operating expenses are critical right now. So what COVID's really done in the last 3 months, it's really forced the technical decision maker to the back of the bus. And that's an analogy we use. And some of the signs that we've done in the last, let's say 2 or 3 months, it's really the financial buyer driving that purchase. And the financial buyer needs a solution. They need a way to pay for that in a lot of cases doesn't force them to go to the bank, and they don't have to write a check. You know, when we were in early April and this whole thing started, the government stepped up and was providing government-backed loans and the $40,000 loan and subsidies. We saw a lot of the banks step up with mortgage deferrals, and some of the equipment suppliers that we dealt with felt that, hey, that's how someone's going to buy my racking or my compressor. But the reality was the government-backed loans have been used to stay open and try to retain employees. And some of the subsidies out there have been used to, again, you know, maintain cash, not spend their cash, and preserve those credit lines. So it really hasn't been used to buy equipment. So it's really changed the marketplace right now and how people are buying everything. If we touch on the bank specifically, we're really fortunate in Canada because we've got a very strong banking system, and the banks do a great job. Most companies either deal with a bank or a credit union for their day-to-day banking. They have a line of credit, they have term loans, and the banks, again, do very well at what they do, especially if we compare it to how it is in the US or other countries. So we've got a very strong banking system, which is great. But as happened in 2007, 2008, 2009, the banks are just starting to tighten up. And we thought this was going to happen, and we were hearing it from a lot of our customers out there, and we've seen it in the news the last month and a bit. And I pulled 3 articles off. The first one's just from the Financial Post in April 29th. Canadian banks expected to tighten home equity line of credit access as aid measures wind down. So, you know, mid-late April, we started to hear more about this around consumer credit and how high the consumer and the commercial debt levels were. And there was a bunch of articles around the end of April around this, around those home equity lines that people have used to kind of put pools in and kind of upgrade their house when the real estate market was so strong. And so that we saw that coming. And then here's another article from the Globe on May 14th. Big banks are tightening lending standards for real estate investors and mortgage brokers. And so that's about a little over 2 weeks ago. And knowing some people in the mortgage business, they have really seen this. And they've had customers that have come in to get a mortgage. And if they had applied in January or December, it would have been a lot smoother process. But now there's more documentation. Most mortgages are requiring work letters to make sure that who's ever signing on that lease are both actually working right now. And so they really tightened. We started to see it kind of mid-May, more and more tightening. And then last week, here's an article from CBC News. Royal Bank and BMO profit cut in half as loan provisions spiked by 500%. Scotiabank and TD Bank came out with the same thing. And some of the credit unions we're talking about as well. And basically what this is saying is the banks are now building in future loan losses that they know are coming. And whether that is on the consumer market, on the commercial market, they know when these government subsidies end and when the mortgage deferrals end, there's going to be some challenges out there. And it's not all doom and gloom. There's definitely some industries starting to come back and do well, but there's going to be a real tightening. And so for you as Sign Association of Canada members, that means when you go to present a proposal to a company to buy a new sign, the bank is not going to be a great option for them like it was 4 months ago. And so all of a sudden, that's going to be a challenge for the financial buyer to go to the bank. We're going to talk about some specific examples down the road, but we want to show you guys how to present your sign and your solution to these businesses and have a better chance of them buying the sign and not forcing them to either go to the bank or write a check for it when that becomes a big challenge for them. I'm going to pass it over to Mike Wilson. Mike Wilson is the National Program Manager for the Sign Association of Ontario and Canada, and he's going to talk a little bit about our credit box and how we do what we do. Mike?
Awesome. Thanks, Chris. So what I'm going to discuss now is what our lenders like to see, how they approve deals and some of the conditions that may show up on a typical approval. So what's our credit box? Our lenders consider all types of profiles, but for the sign specifically, they will approve new businesses and or professionals. The client's profile must be an A profile, meaning good commercial and or personal credit with supportive repayment history and revolving credit. In the circumstances where commercial credit is thin, a co-signer may be required. Now, when credit reviews a deal, they will first review the company's commercial credit. If it's deemed to have a very limited credit, then they will ask for additional support. The most obvious counter to this is us offering a co-signer. in the form of a personal guarantee or another company. Now, to touch on why a commercial credit may be thin, this can be caused by a number of different factors. But what we often see is it's because it's a new business or one that hasn't relied on business loans in the past, resulting in a lack of credit. In terms of signage right now, lenders aren't considering custom signage. So these are signs that are permanently shaped or colored. And the general rule of thumb is that if the sign cannot be reused by someone else, then it's considered custom. Please note that if we're dealing with a more established business, one that is typically 3+ years old, then more options may be available to them, such as longer terms, less money down, better rates, or the ability to have structured payment schedules. Now, on the flip side, when a deal is approved, our lenders provide us with a credit approval outlining the terms and conditions on the deal. It will outline things such as the monthly term. So for signs, our terms would range anywhere from 12 to 60 months, with 48 months typically being the most common. In the event that the approval calls for a down payment, the customer may need to put some money down in order to offset risks associated with the customer's profile. However, with that said, subject to unapproved credit, most sign approvals are approved with a first payment only in advance. Now, when indicated, most approvals will also allow up to 30% of the invoice amount to be soft costs. Chris had touched on this earlier. So as an example, if you have a $20,000 sign, 30% of this cost, $6,000, can include things such as labor, service and maintenance, installation, software, and shipping. And customers really take a liking to this because as a vendor, you can squeeze in a lot of lifetime costs associated with that sign, keeping the cost down for the customer in the future. Now, this brings me to early commencement. The norm in our world when dealing with sign customers and vendors is to get early commencement approved. To give you an idea on how this works, I'll use an example. If a customer is purchasing a $30,000 sign, let's say, and credit approves early commencement, we would pay you 50% of the invoice amount, in this case, $15,000, prior to that sign leaving your yard. The other 50% would be paid to you within 48 hours of installation, giving you the peace of mind of not having a receivable at the end. Now, in saying this, if early commencement is not approved, then we would remit 100% payment to you within 1 to 2 business days once the sign is confirmed, delivered, or installed. Often when early commencement is not approved, credit will ask the customer to put a down payment down. As a vendor, you can collect this down payment as your own security and show it on your invoice, or conversely, we can collect it on your behalf. The last approval condition that I want to touch on is landlord waivers. Landlord waivers are not needed on every single deal. However, it is required for transactions where signage will be located on leased or mortgaged properties, and the sign will be affixed to the ground or structure. So as the broker of record, we would confirm these details with the customer and decide whether this waiver would be required or not. Moving to the next slide. So as most of you know, cash is king. So it's important that when selling to the financial buyer, we focus on these monthly economic impacts and how leasing can conserve cash to be invested elsewhere in the business. Our leasing programs specifically allow customers to use the signs for as long as they need against a fixed monthly payment. So even if the Bank of Canada announces rate hikes, the customer's payment doesn't change. Depending on the customer's advertising needs, there's a flexibility to tailor payments to a customer's preferences, whether it be step payments or seasonal, or they can choose to purchase the sign outright before the lease is scheduled to end and upgrade to new technology or add another sign perhaps. Now, during the beginning stages of buying a sign, some customers may ask, why should I lease? As all of you already know, signs are one of the most important parts of a business's marketing. So continuing to relay this message is important to your customers when trying to sell the leasing option. A high quality sign works as a cost-effective marketing tool, especially when having tailored leasing payments that fit your client's needs. When you're at the stage of trying to sell the sign, not having to worry about upfront costs is a huge advantage for a business. Clients should ask themselves, could the capital need to purchase a sign be better invested in other areas in the company? Well, by leasing, you're effectively freeing up capital that would otherwise be tied up in a depreciating asset. And with any depreciating asset comes service and maintenance. So as mentioned earlier regarding soft costs, as a vendor, make sure that you're including these costs in your invoice amounts, as the lease payments can include these costs, ensuring your client's sign will be cared for the future. The last one here, is a lot of our vendors have testimonials on marketing material that they send out. They showcase it on their website, on social media, and it really adds credibility to your name. So it's important to use case studies and testimonials to demonstrate successful dealings with your customers and really promote leasing as a great alternative to paying cash. With that being said, I'll turn it back over to Chris. He'll go over a recent deal that we did and touch on a few other items before ending the session today. Thank you.
Thanks, Mike. And what I want to say, guys, if you have any questions throughout the presentation, I think you can chat them or text them through the Zoom presentation to Hillary. And then there's going to be a question and answer period at the end that we can answer any questions you guys do have, and she'll read them out to us and go through them. So, you know, here's a recent transaction that we did, and there's a lot kind of going on behind the scenes of this transaction. We'll walk through it. But it's a real world example of a sign we financed, I believe, in March of this year. So it's an outdoor digital sign. The customer is kind of a high-end, not a dollar store, but they're kind of a high-end wholesale store that picks stuff up. And they're on a very busy street. And so the client wanted a digital sign to have kind of dynamic advertising and advertise what he had in there. You know, things like, you know, teeth whitening, where he would go buy, you know, 20 boxes of big teeth whitening things that you could buy for $10 and things like that. And he wanted a lease option. So the digital sign itself was $31,460. We presented an option of $877 a month over 42 months. What was really important to him was that he knew he could take that $31,000 and buy more inventory with it and turn that inventory over and make more money than he could writing a check for $31,000 and plus taxes for a sign. And so the sign company that sold the sign to him asked him that question, you know, what would make more sense for your business? Would you want to pay for this up front or pay for it over a period of time? And I personally got involved in the discussions with the sign company. He said, hey, listen, I know what I can make with that $32,000 if I buy inventory. $877 a month is a lot better solution for me. In this particular deal, the customer was approved. They had good credit. We paid 50% of the price of the sign, so about just over $15,000 once we had signed the lease contract and before the sign company had ordered anything. So they had that money up front, which is a big plus for him. He didn't have to, the end user, the customer didn't have to write a check. The sign company didn't have to buy anything without having that deposit down. So it was great. Took several weeks for the sign to get in and then the sign to get built, and then the sign was installed. Within 2 days of the sign being installed, we had the second 50% to the sign company and everybody was happy. This company that bought the sign is I don't know if anybody's been in London, Ontario, but they're in London, Ontario, and they're based right on Wellington Road, really busy street. And the sign's done a lot of great things for his business. So it's a real win-win transaction all the way around. And we'll touch more on that, on the receivables and that payment after. But this is a real world deal, not a huge deal out there, but that $32,000 was a lot better spent for that customer on inventory, and he knew that. I want to touch on cash flow right now, and some of you might have be dealing with this as well. But what we're seeing right now is with companies cutting costs and doing what they're doing, they're being forced to do this because revenues have slowed and even some cases have stopped. They're not going to have enough cash to pay for expenses in the coming months. And again, it's not all doom and gloom, but we're definitely not out of this thing yet. And one of the things a couple of sign companies that we deal with already have told me is that they've heard this several times in the last month and a half, 2 months. I can't afford that sign. And that's a problem. And if the company doesn't have access to the bank like we talked about before, and they don't have cash flow to pay for it, the financial buyer is not going to be able to buy that sign. You know, so we want to work with you to give you another option, you know, for that financial buyer to afford the sign, to get the sign they want, not the one they can afford. And that's something that we hear all the time from our sign company. So, you know, cash flow is really a key thing right now. It will continue to be a key thing well into the fall and possibly in 2021. And it's just being driven by the huge decrease in revenues that so many of our customers and your customers are having right now. Another option that's out there, and it's pretty popular in the leasing world, is something that we call a step lease. And basically a step lease is something where you step the payments up. And so it works very well in the sign industry. Now it needs to be approved when the credit goes in. But a step lease is something that allows a customer to get a sign in and have very minimal impact on their cash flow. So this is an example of a $20,000 deal where the customer here was approved for the sign. Again, we paid 50% of the sign to the sign company before they had done anything. The sign was ordered and installed. The company was paid 50% within 2 days after the sign was finished being installed. And the customer for the first 3 months had a $99 a month payment. And then their payment stepped up to $685 a month. So this is a great tool to use if you're in a situation where a company is that not now objection. And they're saying, yes, I want the sign, but I don't have the money for it right now, and I want to wait till I do have the money for it. What if we could do this for you, Mr. Customer? What if we could do something over the first 3 months and have a very small payment and then step it up after that? Would that allow you to buy the sign right now? And it's those types of questions and those types of conversations right now in this economy that are getting deals done. And it's fairly simple to do. And not only does it help the customer on their end, but again, that 50% payment upfront to you and 50% upon the installation is a huge deal from a receivables point of view. And I'm sure some of you have dealt with receivables in the past and it's not fun. This will mitigate that risk for you, and we will take on that risk. We want to close out before we get into question and answer period with some what we call best practices and some things that if you can adopt in your business, I commit to you, it will help your business. And these are tried and tested, not only in the sign industry, but in the copier business, when people are buying racking, compressors, trailers. These things work and they will work for you. Don't be afraid to ask a customer, would a monthly lease payment option be attractive for your business? Okay, or some form of that question. By asking them that question, you're going to avoid the situation where you give someone a proposal and they flip to the back page or they scan on their computer to the back page and say, geez, I don't have $32,000 right now. Okay, you want to avoid that. You want to give them options. When you have those options available, make the monthly payment option visible on every quote. It's not enough anymore to say leasing is available on your quote. It doesn't help you. What you want to see is you want a customer to see, okay, I've got an option of writing a check for $31,460. I've also got an option of $877 a month. What is going to make more sense for my business? And in good times, when they have access to the bank or to cash, they've got lots of options. When we get into a situation like this, just like 2007, 2008, 2009, they don't have as many options. And during those years, and even 2010, 11, and 12, leasing took off, and leasing became a huge increase in business, specifically because of the bank and the cash and what was going on. And it's exactly what we're dealing with right now. Mike touched on it earlier about the testimonials. Testimonials and referral, they're critical right now. Credibility in this market is important. If you want to sell the sign and someone has gone out and got 1 or 2 other quotes, you need to be credible to that person. So any testimonies you'll have, get them on your proposals, get them on your website. It will help out. We always talk to our customers about obtaining finance approvals early. And if we want to equate it to something else, for anybody out there who's bought a house at some point, it's similar to getting a pre-approved for a mortgage. Once you get pre-approved for a mortgage, there's a significant chance that you're going to buy a house. It's above 95% that at some point you're going to buy a house when you're approved for that mortgage. You just have to pick the street and pick the house you want. It's the same thing when you get your customers approved early for a sign. Okay, they're going to buy the sign. Number one, it's a great buying signal. If they're interested in the finance option, the monthly payment option, it's a great way for them to say, okay, is this customer real? Okay, if we get them approved for the sign and propose a number, you've got a significantly better chance of getting that sign sold with that early approval. The other thing is all of these things about asking about a monthly payment, putting it on every quotation, testimonials. The sign companies are in a competitive marketplace, and we know this because we've been in a lot of sign sales cycles where there are 2 and 3 quotes that a customer is looking at. And I can tell you firsthand, your chances of closing that sign are significantly better if you've got a monthly payment option on your quote and the person that you're competing against doesn't. Okay, it will increase your sales. And it's the same in other industries as well, and other industries have realized that, but it will work for the sign industry. The last thing that we want to touch on in terms of a best practice is do not offer terms to your customers. And it may seem like a harsh statement, and I know a lot of times a lot of companies do it in a lot of different industries. But I can't tell you the number of people I've talked to in the last 2 months that have offered terms to their customers and they're not able to collect that remaining money. And that's not going to change the next little bit. And I know that companies want to help their customers, and offering a 30, 60, 90 payment term is great to get a deal done. But let companies like Catalyst take on that risk. It's not a risk that you want to have. And I'm sure some of you have dealt with in the past, but we know a lot of companies right now, doesn't matter the asset, that have offered terms. And the 30-day payment will come at 30, but the 60-day payment might come at 120, and the 90-day payment might not come. And it takes you from being a sign company to being an accounts receivable person or a collections agent, and it completely defocuses you off your business, and it really sours the relationship with the customer when you're trying to collect money from them. And I know I've talked to a lot of sign companies that this is a problem for them. So as a best practice, stay away from offering terms now. If you can avoid it, it will save you a lot of headache, and it will maintain your relationship with the client, especially when there's other companies that are willing to take on that risk. Okay, guys, if there's any questions out there, if you want to text them in or Zoom them into Hillary, Hillary will answer those questions or take those, and she will ask them to Mike and I. We can get answers for you. We've also, following the Q&A period, we've got our contact information on the next slide, and we will get that out to you. If you have any questions directly on a particular deal, or just questions about the industry as a whole, you can reach out to Mike. We've got some great tools for you guys to be able to do your own quotations, web-based tools and whatnot that will work well for you. And Mike is going to be the key point person on that. So any questions, Hillary, go ahead.
Yeah, thank you, Chris and Mike. I just want to tell any of our attendees that if you are submitting a question, there is a Q&A field on your desktop version. That would be a bubble at the bottom of the screen, and I'll happily read those out. I do want to ask a question. Now, of course, neither Chris nor Mike have a crystal ball and know when the COVID situation will have passed us. But I wonder if you could talk a bit about financial recovery and how long you would imagine that's going to take.
Chris, do you want to touch on that?
Sure. Yeah, and Hillary, it's a great question. I think it's everybody's wondering about it, and obviously no one knows what's going to happen with COVID. People talk about a second wave. People talk about a cure. And no one knows on that. Talking to a lot of bankers in the banking industry, the real challenge is going to come in the fall of this year. And once the mortgage deferrals end, and once the government subsidy programs either slow down or end, that's when you're really going to see the economic impact of this whole thing. And I know in talking to bankers, the consumer debt levels and the commercial debt levels going into kind of March timeframe were quite a bit higher than they were in 2007. So that is a challenge. So how are we going to recover from this? Yes, we're going to recover from it. I think in the fall, you're going to see a lot more bankruptcies, both consumer and commercial. I think we've seen some of the industries, whether it's hospitality, restaurants, I think those types of industries are going to be hit very hard. Into 2021, I feel this is going to go on personally from talking to bankers and whatnot. How far into 2021, I don't know. But I do believe that there's some industries that are going to come out of this stronger. And I know from people that we work with selling compressors and other assets, they're being smart, and they're focusing on those specific industries. We're doing a lot of business with food companies right now for all kinds of assets because they're growing. I think we're, from an economic recovery standpoint, we're in very good shape in Canada. Whether you like or you don't like Rob Ford, or whether you like or don't like the Prime Minister or your particular Premier, the government is definitely stepping up and helping. It's going to take a long time to pay for this, and it will probably be our kids paying for it down the road at some point as well. But between the government and the banking system, we've got a lot more stability than our friends to the south. There's no question about it. But I think into 2021, you're going to see the real estate market and some of those other markets that are really bellwethers are going to struggle. There's no question into 2021. How far, I don't know. It's a great question, but we're definitely into this, and the fall is going to be an interesting time when a lot of that money starts flowing and people have to make mortgage payments and whatnot again. And again, back to our world, the financial buyer, whether you're a consumer or whether you're commercial, is going to be jumping through some hoops the next while for sure.
Thank you so much, Chris, for addressing that. I'm not seeing any questions in the Q&A bubble, so I suspect that you have answered everything. And I will let you wrap up, and then I have a final slide on my end.
Okay. So again, I want to thank everybody. I know as tough it is out there, everybody we're talking to, all our partners, they're busy. You know, they're trying to help customers right now. You know, in our world, we always say this is with customers. It's like a bank account. This is a great time to make deposits, and this is a great time to work with your customers and help them and do whatever you can with them. And down the road, that will pay off, and we're trying to do the same thing. With this program that we're running, we've had a lot of success with the Ontario Sign Association over the last, I guess, close to a year now since we joined. We understand the assets. We understand, you know, dealing with over 16,000 clients the last 10 years. A lot of our clients have signs, if not all of them. Some work in big businesses and big offices, but I would say 80% of our customers have signs, and we've financed a bunch of them for it. So it's an asset that we understand. And I think if you take some time and reach out to Mike, it will be time well spent. And it will absolutely help you not only offer something to your customer, but also eliminate any receivables issues that you have. And, you know, a lot of the vendors we've worked with for a long time, one of the things they will tell you is, you know, offering a leasing option will make it easier to sell your product. It really will, even before this happened. And I think you'll see that going forward. And again, you will sell signs and we will finance signs. It'd be time well spent to spend a few minutes with Mike on this. And I believe Hillary is going to send the presentation out to about the recording. So everybody will have that contact information, but you can take it down. You can give Mike a call. You can shoot him a text, or you can shoot him an email, whatever works, and he will help you out with this.
Absolutely. I am just switching to my final slide. And there we go. So thank you again for your presentation. I do want to thank you for your time and for everybody who joined us today. Everybody who registered for this webinar is going to get sent a recording as well as a copy of the slides so that you will be able to reference those moving forward. And I hope you'll join us for more SAC webinars of great quality like this. Our next one is coming up in 2 days on June the 4th, and that's 4 to 5:30. It's going to be a much more casual meeting. It's from Breaking Barriers, which is for women in the sign industry. It's a happy hour. The topic is going to be about work-life balance, and it is open to everybody, members and non-members. It is totally free, and although it is from the women in the sign industry, we do encourage everybody to join. There's no limits on that. And we hope to see you all there. I know that there's more webinars coming up. I just don't have confirmed dates, but we're going to keep on going and keep presenting. So with that, I thank you so much, Chris and Mike, and we'll wrap it up there.
Thanks, Hillary. Thanks for the opportunity, and thanks, everybody. Hope everybody has a good, safe day.
Thanks, guys.
Thank you.